Joining us now with his perspective on what this means for future growth is Dean Maki, chief U.S. economist at Barclays. Bloomberg ranks him among the most accurate forecasters on the U.S. economy in the world. So great to have you here, Dean. Let me start by asking, in relation to Ben Bernanke's speech yesterday, he kind of implied that we're going to come back, or straight out said that the economy is going to come back from this little slowdown. Transitory, I believe, is the word that he used on so many different occasions yesterday. Do you agree?
Yes, I do agree. I think we're in a very similar situation to last year. Second quarter of last year, we had a weak print of 1.7%. A lot of people overreacted to that and cut their forecasts throughout the year, and that turned out to be a mistake. The economy did bounce back, and we think, just as was logical last year, we will see a bounce back this year as well.
Nonetheless, overall GDP growth in this recovery has been muted or even disappointing. 2.3% if you take a look at the average since the bottom, or since the recession ended. Do we need to see more of a serious pickup before we can, for example, add jobs? Because we had disappointing jobs data today as well.
We think we are in the range now where the corporate sector is going to be adding jobs at a solid pace. We've already seen the payroll numbers pick up above 200,000 per month, and we think we will be in that range through the rest of the year. The corporate sector had a lot of uncertainty to deal with early in the recovery. While there's always uncertainty around, we think there is a bit less of it now, and that's one of the reasons job growth is picking up, even with only moderate growth in GDP.
So economists typically say first-time jobless claims should be below 400,000 for us to be adding jobs. We've got a read of 429 today. We also hear that GDP growth should be above 3%. Are you optimistic that we're going to get back to that above 3% and below 400,000 relatively quickly?
Well, we do think that we will bounce back above 3% already in the second quarter. We're looking for 3.5% growth. One thing I would emphasize, though, we believe potential GDP growth has slowed to about 2.25%. So even the 2.5%, 2.75% kind of numbers will push the unemployment rate lower and will be associated with job growth. So I think we have to get used to a bit slower GDP growth than used to be the case in the past.
So where does the job growth come from? I mean, the Fed yesterday saying that there isn't really a direct effect on jobs from monetary policy. And we all know that the mood in Washington has changed from spending as much as we can possibly borrow to cutting maybe, or at least staying flat as far as spending is concerned. Where does job growth come from going forward?
We think the job growth will continue to be powered by the private sector. Consumer spending, while it slowed a bit this quarter, still at 2.7%, was reasonably firm, especially in light of the surge in headline inflation that consumers experienced. And looking over the past couple of quarters, we've been averaging better than 3% on consumer spending growth, and we think that is what's likely to continue going forward. The business sector is also spending. Equipment and software investment up at another double-digit pace in the first quarter, and we believe, given the profit picture, that corporations will continue to spend. So it's really consumers and businesses driving the economy right now.
Speaking of driving, the CEO of Walmart, Mike Duke, coming out and saying that he's concerned his customers are running out of money. Speaking of inflation, where do you see that sort of tug of war? Inflation, is it rising to a level where the Fed is going to have to come out and raise rates and then possibly dampen growth?
We expect that headline inflation will remain elevated on a year-on-year basis throughout the year. So we're looking for the headline CPI to rise to nearly 4% this summer. So we don't see any extreme relief coming anytime soon for consumers. At the same time, in the first quarter, we had a surge above 5% on inflation. We don't think we'll maintain that, however. So we're somewhere in between there. We do think inflation is elevated, but it will slow a bit from this very strong first quarter pace.
All right. Hey, Dean, thanks very much. Always a pleasure. I could interview you for hours and hours. So thanks for stopping by. Dean Maki there from Barclays. I want to